Okay, welcome to the afternoon, day two afternoon session of our fiscal conference. I'm very pleased to be able to play a small role by chairing this session. But of course, we do consider fiscal policy to be a very important topic for the ECB to study for all sorts of reasons. Let me also emphasize, of course, that debt, sovereign debt, plays many roles in our analysis. And of course, there's at the very least two perspectives to think about. One, of course, is from a macroeconomic point of view, but there's also the very basic mechanical issue that sovereign debt, of course, plays a very important role in the financial system. So when you have a situation where you need to take both a macro view and a finance view of the role of fiscal policy and the role of the outstanding stock of government debt, this is very important that we actually bring it together. So you can read many papers from finance professors, many papers from macro professors, but actually in the end, we have to have an integrated view. So for that reason, I think it's really well fitting that we have Ricardo Reis to give a keynote, because Ricardo really, I think, has been one of the main contributors to work at that intersection point. That to take seriously that the financial system is complex, sophisticated, and to take seriously, if you like, the kind of line of thinking from the asset pricing and finance literature, but simultaneously fully understand and take on the challenge of working out the public finance and macroeconomic implications of government debt. So I don't want to say too much. I don't find it necessary to say too much about Ricardo, because he's so well known as one of the world's leading macroeconomists, very well known in the central banking world because so much of his work is directly relevant for us. And with that, let me hand over to Ricardo. And Ricardo will present, and then there should be some time for Q&A after that. So over to you, Ricardo.
Thank you very much, Philip, for that introduction. It is a pleasure to be here and to share this work with you. Sorry. Okay, great. So let me put here my slides and go into full screen. Oops, sorry. This is not letting me go full screen. Okay. Okay. Oh, because I'm already full screen. No. Oh, it's fine. Sorry, my apologies. This was just.
Take your time, Ricardo. I'm sure you can take your time to set it up.
Because the full screen stopped working all of a sudden. Well, let me try again. Apologies. And so let me do the share again. Screen 2 and share. Okay. Can you now see the slides?
Yeah. Perfect. Yeah.
Perfect. So. So let me just take your. Okay, well, so it's a pleasure to be here and to talk to you about actually some relatively recent research, which fits, I think, well into Philip's introduction, insofar as it is really quite at the intersection of macro and finance. I have this title, which may seem mysterious, but which actually I think is going to capture very well what I'm going to say. But importantly, the next 40-50 minutes, what I'll be telling you is really giving you a literature review of a literature that has grown in the last 9-12 months. A remarkable number of papers that have come up thinking about that sustainability from a fairly common unified perspective and bringing, I think, new insights into how we think about that sustainability. And I will talk also about how that intersects with policy options, such as the ones that ECB and the members of the Euro area share. But the starting point for this literature is two papers that were written at approximately the same time a few years ago that really revived our interest in debt sustainability. One of them, perhaps the most famous one, was the presidential address by Olivier Blanchard, who noted that even though the interest rate on debt in the US had always been on average below the growth rate of the economy by 30-40 basis points on average from the 18th century until 20 years ago. In the last 20 years, that gap had grown, and that had now become the norm in pretty much every advanced economy. Given that, that means that a one-off spending, if R is less than G, a one-off spending with enough time elapsed will mean that the repayment of that debt, even if the R is very high and we're talking about many years to repay the debt, because the G is even higher, those many years will be a declining share of what GDP is in the economy. With R less than G, issues on efficiency, sustainability of the debt, desirability of issuing more debt become attract a renewed interest, and Olivier very effectively made that point. Roughly at the same time, Neil Marotra and Dmitry Sergeyev, in a paper that's only now forthcoming, noted that with R less than G, it doesn't mean that the debt, though, that you can sustain any debt. It would be a fallacy to go from saying that one-off increase in spending can be paid, such as I said, that applies therefore to continuous increase in spending. But still, that when R less than G, you can still talk about debt sustainability insofar as there are still limits on how much you can spend in a consistent, permanent basis. And moreover that, looking at R and G alone, a little bit like Olivier had done, can be misleading because it depends on what is the source behind this gap between R and G, whether you can actually spend more or less. That was the kicking point for this literature. Here is what fairly soon I think economists have realized, or at least a small group of economists that grew very fast realized. Let's start with the budget constraint of the government that says that the increase in debt is equal to the primary deficit plus the payment to bondholders. And just set notation, the change D in debt, B, is equal to the net spending or primary deficit, and the payment to the bondholders equal to the so-called R, the payments on the bonds, times the total amount of bonds. This is an accounting identity. There is no economics in this. Likewise, there is no economics in the next equation as well. You can always write a differential equation in integral form. In particular, and I'm going to simplify only insofar as I'm going to say that both debt and GDP grow asymptotically at the same rate. So I'm not going to be considering the case where the debt becomes infinite share GDP or zero GDP. Doesn't seem particularly interesting. With that single simplification, then if I take dt to be any sequence, and there's an infinite such sequences, with a property that the lim sup of that sequence is above the lim sup of the G sequence, okay, so the convergence subsequence maximum is above it, then it is a mathematical restatement of this accounting identity to write the following equation. That the debt to GDP is equal to an expected present value discounted by D minus G of the primary surpluses. Oh, sorry, I forgot to divide here by Y, GDP, plus this other term, which I will tell you much more about soon. This is accounting and mathematics. There's no economics in here. The standard next step that has been done routinely over the many decades in which we've studied debt sustainability is to say, well, which D to use? Well, let's simply use the R, the same interest rate at which you pay debt. Not only if R is bigger than G, then the conditions holds. Moreover, by setting D equals R, we can forget about that second term and focus instead on the first term. Debt to GDP is then the expected present value of primary surplus over GDP. Mathematically is convenient, but it also makes sense. Since how are you going to discount your surpluses? Well, discount them at the rate at which those surpluses or deficits will pay interest. It is the rate at which the government can borrow, and with complete financial markets, since there's only one rate, take this as simply being the risk-adjusted return in the economy. It's simply, and finally, this is simply a transversality condition. The constant assumption has been this equation. And this equation has been the bedrock of all analysis of debt sustainability for decades and decades of classic debt sustainability analysis. Let me review for you briefly what that sustainability analysis has been about. Again, always from debt to GDP is equal to an expected present value discounted by R minus G of primary surplus over GDP. First part of debt sustainability is build forecasts of what deficits will be into the future, such as the CBO forecast for the US using current law, forecast Social Security, public health, taxes, and then build these expected present values and figure out whether they are above or below the debt to GDP. You then discover whether debt is sustainable in the economy, are generating enough surpluses to pay for it. Difficulty, of course, with this literature, for those of you who have tried to work on it, is that it is very, very hard to forecast things at a long horizon. And moreover, that you always face the issue that in so many countries, all the forecasts show deficits for the next 50 years, but insofar as you have positive debt, at some point you have to have some surpluses. And as a result, you end up making things up after 2050 in order to even have a hope of having a left-hand side that's positive and a right-hand side that's positive. It is a hard task. A second form of analysis of sustainability, pioneered by Henning Vaughan, was to think in terms of instead fiscal rules. Fiscal rules of the type, what surplus will the government try to achieve through choices of taxation and spending as a fraction, as in response to the debt over GDP. And what Bond showed was that as long as sigma is positive, that is, when debt to GDP rises, the government either immediately or eventually responds by raising surpluses, i.e. raising tax or cutting spending, then this equation will automatically hold. That is, this equation implies that. Okay? We have gone and estimated this equation. Here I have recent estimates from Derazzo, Mendoza, and Zhang. And the fact is that those sigma always turn out to be positive. And in that sense, you end up with the fact that it is ultimately sustainable. And to understand why I really like this picture, whenever you have a very large debt crisis like a civil war or world war, you do see that you do have surpluses afterwards. But note also that more recently, as we move away in the case of the United States from the Civil War, World War I, Great Depression, this has become less and less the case. So the sigmas are looking much more like negative. And so we end up with, given that it's hard to estimate these sigmas, being less sure about sustainability. A third approach to that sustainability has been to think in terms of Laffer curves. As I do particular policies that change primary surpluses, to what extent do those policies actually increase surpluses or lower surpluses? And how does that interact with how they change R and G? For that, you need equilibrium models, DSGs or some other models, and it becomes hard. You need to then trust the model to understand to what extent that is sustainable, that is, to what extent there is room to, if needed, raise those primary surpluses and make the equation hold. Fourth approach to sustainability goes back to the famous debates following this picture from a paper from Blanchard and Lee about whether austerity is a good or a bad idea. What are those austerity wars as they came to be known? If you raise surpluses, maybe you lower the growth rate so much that R minus G increases, and so the right-hand side actually falls. The present value may increase or fall. The answer to whether that effect is bigger than the direct effect on the surplus depends on multipliers, and thus the debate on that. Default. You may choose to default, and that's a wonderful way to bring down the left-hand side. But if people expect it to default, they're going to require a higher interest rate on the government debt, which increases R minus G and lowers the right-hand side. What that is sustainable in models of default and voluntary default if no default is the equilibrium, and it has been a general rule in that literature that there is multiple equilibrium, and that debt that we observe seems to be much higher than what would be justified by sustainability. And finally, work on structural reforms. To what extent I can raise G eventually in the long run, but at the cost often of lower surpluses, spending plans in the short run. Am I increasing the expected present value, or am I instead leading to defaults? Instead, to what extent do I want to implement costly reforms when they involve long-term gains and short-term costs? So, in a very, hopefully, helicopter view way, I've tried to summarize to you what has been ultimately 50, 60, 100 years of debt sustainability analysis, all of which, crucially, is about measuring this term. We have generated enormous research on this. In many ways, if you work in the Fiscal Council or in the IMF, your life is to think about this equation, think about these 6 trade-offs that I mentioned, and some associated ones, and with many, 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 many subheadings in them. But when R is less than G, you can no longer start from the accounting equation and simply derive this equation that has led to all that sustainability. Purely mathematically, if you even try, because you really want to use your old math, you fail because you realize you need to take a limit of 2 things that when added, one goes to minus infinity, one goes to plus infinity. You simply cannot use D equals R in your mathematics. And moreover, R less than G, as I noted in the introduction, is no longer a theoretical curiosity. It is the norm across most advanced economies and it has increased and become more clear as one looks at the last 20 years. R is less than G. Classic debt sustainability analysis is therefore incomplete. What needs to be complete then is to consider a second term, because R less than G does not mean that there is no budget constraint. I told you the budget constraint was an accounting mathematical identity. What it means, though, is that we need to use some D, some discounting bigger than R. Let's call that M. Remember now that GDP was equal to expected value, but we were discounted by M minus G. And now there was a second term, which also discounted by M minus G was equal to the gap of M minus R times the debt. What should that M be? Well, if we have complete markets, then there is an easy answer to that. With complete markets, there's a unique discount factor to all future revenues. It's called sometimes the SDF, or stochastic discount factor. In the language of the CAPM, this is the market return. Thus, my words M. It implies everything relative to M, the market return, the betas with respect to the market return. What is then M minus R? M minus R, you may say, is simply the risk premium. If R is the safe interest rate on the debt, M is the return on equity on the market. M minus R is what you would call the risk premium. If markets are efficient, then we're back to this term disappearing. The expected risk premium is zero. But if markets are inefficient, then you see that we have an extra term that arises from the fact that the government can borrow at a safe rate. Its surpluses, being risky like any other thing, are going to be discounted by M, and the gap between M minus R, the equity premium if you want, is going to be something that the government is going to earn as an extra source of revenue because it taxes the economy, which is growing at M or giving returns at M, even as it's paying a safe rate. With incomplete markets, it becomes more interesting even, because then there's many M's. We know there's many stochastic discount factors. What is the market? Well, that depends. Luckily, from the perspective of a macroeconomist, there is a robust M, and that is the marginal product of capital. Luckily, that starts with an M as well, just like market. What are the virtues of using that as a D, as a discount? Well, first, the marginal product of capital in an economy, in a macroeconomy, like Philip was saying, think finance, but think macro. Ultimately, we can talk about lots of different financial assets, lots of discount factors depending on frictions. But there's always one thing that in a closed macroeconomy or open, in a macroeconomy has to happen, which is you can invest in the capital stock in the economy. Therefore, M is always a valid stochastic discount factor. Second, for the marginal representative investor, even if you want, in an economy that has macro and finance, an alternative to buying government debt is always to just put it in the real economy, get the marginal product of capital. And third, M bigger than G. Remember, we need to use a D that's bigger than G, and I'm going to use this marginal product of capital. Well, that is the transversality condition, the dynamic efficiency condition that we know that optimizing consumers will always choose to hold. In that case, what is that M minus R? M minus R is what finance people would call a liquidity premium, some gap between the interest rate on debt and the marginal product of capital, where liquidity is here used in the very vague sense of debt is very liquid, the capital stock is not. This is the term. What is then the debt revenue term? That is my name and thus this title of this talk for the second term. The expected present value of the flow of MPK minus interest rate on government debt times the amount of the debt over GDP. Okay? What is this? Well, or where does this come from? Well, it depends on what you, first of all, just an interpretation. It's the revenue for the government from providing public debt that for some reason pays a lower interest rate than the other returns of the economy, the MPK. And people are still willing to hold this government debt. What is this? What has been the name of it that people have done as we write across models in macrofinance? Some people call this the bubble premium on the debt. It is the fact that there is a bubble that is able to sell at a lower return, i.e. sell for a higher price than would be justified by fundamentals in an arbitrage CAPM sense. Others would call this the convenience yield of the debt. That is convenient relative to capital, which is inconvenient. Let's call this convenience yield. And we can write models of what that convenience comes from. Others will call this the safety premium of the debt. They will say that, look, Government debt is safe. We have a desire for safety imposed by regulation or by preferences. Capital is risky. This is the cost of getting that safety. And others still would, especially if you're more of an economic historian, will call this the repression premium. And indeed, the work by Carmen Reinhardt was, and going back to Ron McKinnon, was very much of measuring M minus R's and saying this is a repression of the government who's being able to pay you a lower interest rate than you would have by selling its debt. Either way, this is a source of revenue for the government that the conventional debt analysis that focuses on the first term has missed out completely over the last many decades. Okay? If this still seems mysterious, and you are not a finance economist, but you are more modestly trained like I was as a monetary economist, let me remind you that you have seen this at some point in your life. We just called it a funny name. You called it seniorage. Why? Imagine the government can only issue two types of debt. One that pays a real interest rate R, and another one that pays a real interest rate minus pi. We usually call that second one money. What is R minus G then? It's R plus pi, also known as the nominal interest rate. This then is, that debt is then money, and simply the debt revenue term, which is the nominal interest rate times the money stock, is what we used to call seniorage. So if you want, you can call this also the seniorage revenue. This is, though, the seniorage from one specific type of public debt, money, currency, but there are many more types of public debt, and nowadays they all pay a very low interest rate. Likewise, if you come instead from you're trained as a finance economist and you still find this mysterious, let me drill you in that you've seen this before. The literature on QE over the last decade has discussed how with different bonds, let me indexed by J, may have different premiums, returns relative to the one period rate R. In that case, this term is simply the premium of that bond times the debt of that bond. And this is the revenue term that arises. These are the arbitrage opportunities in the classic work by Dimitri Vayanos and others. That, in their work, is what the arbitrageurs are capturing. But here, note, is what the government is capturing from the respective example government budget constraint. Okay? So, in short, here we have the literature by doing basic mathematics and then having one insight. Let's use M, the marginal part of capital, the market return, as the discount rate to plug in the mathematics. As said, here is a new term to consider. And you can therefore see the excitement of researchers when told, look, there are hundreds of papers measuring this term, trade-offs, interesting theory, interesting empirics, how to measure it, estimating fiscal rules, figuring out multiple equilibrium models. Well, there's a new elephant in town. There's a new term once you realize that R is less than G and that a proper discount factor is M. Let us now try to measure, model this term, which again, I'm coining in this lecture, the debt revenue term, because every different paper calls it a bubble, a convenience, a safety, a repression, a seniorage, and I'm trying to use debt revenue. It is the revenue from issuing debt as a common thing. So let me now tell you about what those papers are and how they've been fitting together. Let's start with measuring this term. How big can it be? And this is from a paper I wrote some months ago, I think a back of the envelope that immediately reveals to you the excitement around this literature. If you look at gaps between the marginal part of capital and the interest rate, if you calculate marginal part of capital in a very generous way, which is this purple line, which is you just look at capital income in NEPA, do some adjustments for proprietor's income, you end up with numbers around 10 to 12%. If you look at the interest rate R, that's been around 2, 3, 4%. You therefore end up with an M minus R that could be as high as 8%. If you look at other measures such as leverage adjusted equity returns or corporate bonds, and I'll talk about some more of those, maybe M is only a couple of percentage points above R. Either way, it's between 2 and 8%. But now, take the debt level to which we are closely approaching as the average in the G7, 150%. 150% times 2 is 3% of GDP. 8 times 1.5 is 12. That means that the flow in that new term is somewhere between 3 and 12% of GDP. Think now, when was the last time that a rich economy ran a primary surplus of 12% of GDP? Not in a very long time. What that tells you, therefore, is that in terms of possibly how large this term is, it can be very large. There is a lot of potential for this term to be at least as large as the other term that everyone has been focusing on for 50 or 60 years. It is possibly a very big number. Okay? And it implies, therefore, that if it's 3, 4, 5% even, we could run a primary deficit forever, because if you run a primary deficit of 1 or 2% forever with a debt revenue term of 3 or 4% forever, that may well be enough to sustain the current public debt of 150% GDP. Still, here is how the literature beyond moving from this, I think, quite eye-opening, or at least it was extremely eye-opening to me when I did this in an office in Basel as I was visiting the BIS last October, and I first put these numbers and understood the potential in them. Here is what a literature very quickly emerged to try and put some more substance in. First, in a series of paper by Jiang and company, they said, hold on, I don't know how to measure this, but we can measure it as a residual. Old tradition economics, if you can't measure something, measure as a residual. Let's look at debt GDP minus the present value of surpluses. And their point was that when you use measures of M, of the type that one uses to price stock returns, you end up with a debt revenue term that is gigantic. So large indeed that there must be something going on. It can't be 400% of GDP. And therefore they call this a debt valuation puzzle. This is partly because when you use the M to discount the primary surpluses, because M is bigger than R, you get that this term is low. Our previous measurements of this term were inflated because they're really conflating, by trying to force that revenue term to be zero, they were conflating some of that revenue as being really present values of surpluses. And second, because surpluses are pro-cyclical, that means that any risk adjustment that you do is going to subtract from the expected present value relative to the present value expectation. So you end up with puzzlingly high, very large numbers. This has been done also for Holland to show that there, the debt revenue term is either negative or 50% GDP, but more importantly, that as you change slight parameters on how you think the initial value of surpluses are, how they may jump, you may end up with this term going from 0% of GDP to 100% of GDP very quickly. In other words, measuring this as the debt revenue is super sensitive to parameter values, not particularly robust. Still, qualitatively, I find quite enlightening the calculations from Chen and company for the UK. Before World War I, the gilts issued by the UK Treasury had a very special role as the center of the financial system. Afterwards, they were replaced by the treasuries. Even if the numbers are hard to measure, note that if you look at the debt revenue term, what their estimates show is, as you'd expect qualitatively, a decline in the specialness, in the liquidity premium, in the convenience, the bubble, whatever you want to call it, of the public debt, precisely as you would expect. Okay? Now, what if we go and say, forget about measuring this residual, let's try to measure this directly. Now, one simple way of doing that, actually, let me start here, let's start here, which is, what if I think of M, again, here we have to think about what's the alternative to the government debt, as being investing in very, very safe corporates, say AAA corporates. In that case, we end up with the M minus R being around 1% or so. Okay? And this goes back to the work, seminal work by Krishnamurti and Vissing Jorgensen, saying M minus R is about 1%. Alternatively, say, no, it's not very safe corporates. Maybe the M alternative is foreign investments, foreign sovereigns, in which case you again end up with not 1, but even lower, 0.5%, as in the work by, again, Krishnamurti and colleagues. Issue with those is that these are clearly an understatement. They are a measure of the alternative to government debt being only very safe corporates or very safe sovereigns. Or likely, instead, we should be looking at broader corporates. That is, we should be looking at the extent to which the alternative to the government debt, the market, is instead broader corporates. And if you look at broader corporates, you start ending with much larger numbers. But perhaps more importantly is to realize, hold on, why? After all, M is the marginal product of capital in the economy. What I want to look at is, what if I invest in the capital stock as measured by the rate of returns on capital I showed you, those 10%, or housing, or larger corporate bonds, or equities as a whole. And on those, again, you end up with numbers that are more in the order of 5, 6, or 7%. In short, when we have gone and measured this term, we have learned that at very active work, trying to measure it, we've learned that measuring as a residual shows again the potential for it to be large, but if anything, it is too large. If we try to measure it directly as spreads, then we end up discussing what do you think is the alternative to government bonds? Is it corporate bonds? Is it equity? Doing so is what in incomplete markets is what's going to give you what is the right measure of this flow. It is, even in the smallest numbers, 1%, which is if you only take very safe corporates, 1% times, again, 150% of debt to GDP is, or even that, is 1.5%. That is serious money. Again, it's a 1.5% flow revenue from issuing debt. But as I said earlier, this could be as high as 10% or so. But you see how there's been a very active literature just trying to measure this term. What about theorizing about this term? Why do I want to theorize about it? Just like in standard debt sustainability analysis, so I understand what trade-offs come with different policies. And so let me give you an overview of some of the theories that have been proposed. All of these papers on measurement were written in the last 9 months, or interpreted in the last 9 months. Likewise with these papers on theory. Okay? I'm going to start just with my own paper on this 12 months ago, which was one of the first. Okay? You have to ask always 3 questions. Where does M minus R come from? You have to micro-found it, model it. Then ask, what is the key trade-off, the key reason that's for which the reason why M minus R can move with B, so you understand the whole flow revenue term. And third, how will policy affect it? So let me tell you what I did. I said, well, in this first paper, maybe the reason why there's an M minus R is that there's households with bad investment opportunities want to store value to when they're more productive. In other words, that private credit markets are limited in terms of how much private borrowing there is, and therefore people like government bonds because it allows them to store value into the future. The key trade-off there is then between issuing more government debt and private credit markets, namely that in order to have more debt revenue, it requires that the government debt is more special. What is the alternative to government debt? Private debt, private credit markets. That is the key trade-off. In particular, then, there's a fiscal capacity, an upper bound for spending of how much you can pay before the debt revenue term disappears. The policy predictions from there, one of them relevant to the ECB. In conventional analysis, you always have a temptation to inflate away the debt. A little bit of inflation is wonderful because it lowers the amount of the debt that you have in real terms for fixed primary surpluses. But here, it is the other way around. You always want to be extremely committed to price stability when you have a lot of debt. Why? Because it is by being extremely committed to price stability that the ECB removes inflation risk from the Portuguese, Spanish, or French bonds, and in doing so, makes the government debt safer, more special, and thus maximizes its debt revenue term. So you get a very different and interesting policy prediction, which is the opposite of what the literature on the first term has emphasized. More generally, changes that make private credit markets work better, whether it's associated with financial development, inequality, safety, welfare state, they will all either make government bonds more or less desirable relative to private credits, and in doing so, lower or raise the net revenue term. Quite related, Angeletto, Scolard, and Della said, well, debt is used as a collateral in trades across households after taste shocks. The key trade-off then is that you want to alleviate this financial friction, but if you alleviate it too much, there's no longer any revenue from the government from providing that debt to use in that collateral. And you like the idea of having that revenue term because you can then smooth shocks with the debt revenue term as opposed to using distortionary taxes. Interestingly, they show that you may actually want, therefore, to again, very different from the conventional analysis of the first term, you may actually want to love austerity instead of paying very aggressive for deficits. Why? Because what's very important, even if this requires some distortionary taxation, you want to preserve the safety of the debt in order to be able to benefit from that revenue term and be able to use it to smooth out some potentially smaller shocks in the future. Third paper, Schmidt, Liu, and Yaron say that maybe MNSR comes because households have idiosyncratic risks of having to liquidate their investments in order to consume, but there's transaction costs in selling assets. Government debt is special because it has the lowest transaction costs out there. It is the one easiest to sell if you need it. The key trade-off then is the following. If the government issued more bonds, it would satisfy that demand for liquidity. But in order to pay for those bonds, it would require having potentially higher and definitely more volatile taxes. This would raise long-run consumption risk in the economy, raise risk premium, and lower investment and growth. In other words, creating a higher debt revenue term may come with a trade-off in that it increases the long-run risk in the economy. Therefore, they say it is tempting to use the debt revenue term, but insofar as this generates fiscal risk, this can generate aggregate economic risk, and in doing so, actually end up in an economy that is worse off. Marco Bassetti and Wei Kui, already a few years ago, a precursor in this literature, if M minus R comes from an OLG economy with dynamic inefficiency, where we have that the price of capital of bonds here are special, useful, because they allow young generations to transfer resources to when they're old, then they note in the context of price level determinacy and monetary policy that if you have active fiscal policy in the FTPL sense, this will no longer select a unique equilibrium. It's not enough to have passive monetary active fiscal. Why? Because the debt revenue term, that new term, depends on the price level as well. Remember your fiscal price level, you have debt, present value surpluses. Therefore, if you have an active fiscal policy on the present value surpluses, that pins down the P on the debt. But now there's another term, a debt revenue term. Active fiscal policy is no longer enough to generate an equilibrium. Okay? Policy predictions, the sources of that revenue term change significantly with the fiscal rules. That is, whether austerity, for instance, to inflation or deflation, depends on the fiscal rule. The link that fiscal irresponsibility comes with high inflation is no longer actually clear or true at all. It depends. Quite related, more recently, Brunemeyer, Merkel, and Sannikov have a model where M minus R comes from idiosyncratic capital risk. The key trade-off there is that when the price level rises, because the nominal assets of private institutions fall, they will now change their demand for the public bonds. With higher price level, they have nominal assets that are lower. They would want to buy, if there's especially more risk, less public bonds or more public bonds. Again, as in Bassetto and Cui, active fiscal policies no longer ensure determinacy of inflation. And moreover, they note that the fiscal policy rule for surpluses off equilibrium will affect the size of their revenue term. Why is this particularly interesting if you're a monetary theorist? For years, we've learned that monetary policy rules pin down inflation only by appealing to off-equilibrium behavior of that same policy rule, and that has been an argument for why maybe fiscal policy rules, FTPL, may be, let's say, more theoretically appealing way of thinking about equilibrium. But now, instead, actually, you have that the FTPL, if anything, is the more robust, more fragile way of thinking about price determinacy, because now it depends on off-equilibrium behavior, now in the case of the fiscal policy rule. Guillermo Calvo and Andres Velasco, very interesting paper again on this fiscal monetary interaction. So they just assume that the M-R comes from utility, from government debt, but they say, going back to an old tradition that goes back to Miguel Sidrowski, that you get some utility from debt and a different utility from currency. Their key trade-off is the following. Whereas the price level is sticky, the price of the government debt, being an asset, is not. Therefore, when there are shocks, the price of the government debt is the one that jumps. Therefore, the debt revenue term is the very volatile term when you look at that sustainability. It is the new term is the unreliable term. Their policy predictions is that then that volatility comes with volatility in taxation or government spending, affects aggregate demand and output, and they therefore find that actually, if you do a fiscal spending that's paid by bonds, you can easily be contractionary as opposed to expansion on that because of this new effect. Finally, or not finally, I think I have two more. Miao and Su, where does the M-R come from? From firms now that have credit constraints in idiosyncratic risk. The key trade-off is that public bonds relax firm credit constraints because they can be used as collateral. The policy prediction is that the debt revenue term, what they characterize is the Laffer curve sense of it, and the extent to which a fiscal target for the debt can eliminate the fact that you may end up with two equilibrium depending on which side of the Laffer curve you happen to be. But now it's not the Laffer curve on taxations, it's the Laffer curve on the debt revenue term. And finally, Atif Mian, Ludwig Straub, and Amir Sufi quite recently. Again, M-R just utility for government debt, as in Calvo and Velasco. But now they note, wait a second, at the ZLB, if you issue debt, because issuing debt lowers the interest rate, therefore, the low interest rate comes with boosting output and boosting primary surpluses. Therefore, you end up with issuing debt paying for itself, because now an attempt to increase the debt revenue term increases output, increases the present value of surpluses, and therefore has an extra bang for the buck for what that does. Finally, and much more recently and a little more tentatively, does this debt revenue term lead to money pumps, and how does it affect welfare? Robert Barrow, in a very recent paper, noting that recurrent equivalence still holds in these models. And the insight here really goes back to Miguel Sidrowski, and especially to some extremely insightful papers by Philip Weil in the late 1980s. Even if there's a debt revenue term, if the government comes to you and says, here is a transfer, which I will tax you later on, even though it seems like that it may give you a debt revenue term because the government is going to later on, well, it can use the debt revenue term to finance that transfer. Actually, there's been no change in net wealth at all, and therefore pure issuance of debt will not increase net debt insofar as I know that I'm going to pay for that transfer. Boll and Mankiw, in a paper gone also 6 or 7 months ago, note that even though in these economies there are Ponzi schemes, there are bubbles, that does not mean that welfare is higher or not. And they do it by thinking of M-R coming from firm market power, and therefore, even though more government debt may crowd out capital, even though more government debt may raise welfare by OLG reasons, it will, with market power, potentially crowd out capital, and then it depends. And finally, I'm a little over my time, is the existence of a debt revenue the same as inefficiency? Martin Helvig, in a paper a year ago, or a little less, noting that, yes, M-R-N-G is what matters for debt revenue, but for welfare, it's R&G, and related work by Kotlikov, Kugler, and Owens, putting numbers into it and saying that this is perhaps less likely when you put numbers in it. And finally, that if instead of OLG economies, you look at IAGAR economies of Socratic risk, a great paper by Narayan Kushal Lakota showing that actually increasing debt revenues coincides with increasing welfare, and much more, very recently, paper by Mark Aguiar, Manuel Amador, and Cesar Arellano, deriving a condition in those economies under which that holds, and it turns out to be a condition that says that that revenue term is bigger than R times capital stock. To conclude with this overview, the survey, I try to make 5 points. Classic debt sustainability focus on present value surpluses. Has been many insights, but it has still left many questions unanswered. More recently, we have learned there's a new term. I call the debt revenue term. R less than G means the term exists, but its size is really about M minus R. Measuring it has shown that it can be large, but we're still struggling to pin down how large or how small it is. Modeling it has been very exciting. Different trade-offs, new policy limits, new possibilities to think about how debt is sustainable or not. And finally, that relaxing the governmental constraint does not mean improving welfare. It depends on where the R less than G and the M came from. Thank you very much for your time and attention, and I'll open it now for questions.
Thank you, Ricardo. And I should say from my perspective, this is very much the model of a keynote, because not only have you provided this synthetic overview, so that I and everyone else can kind of frame this whole literature, but also just at the end of going paper by paper is also quite helpful as well. I'm scribbling notes to myself to see what to follow up. So let me turn to the, and I encourage everyone to offer questions and comments. And the first one I see in the chat is from Klaus Mazuk. And the question is, of course, the value of having, the safer you make government debt, the more it can provide this kind of these services. But there's, I think, also a finance literature about if you make government bonds safer, and then let's imagine bad states of the world. Maybe there's some shifting of costs to those who do not hold government bonds, so the less wealthy. So this is a kind of question which I think comes from this paper by Jiang et al. About thinking about the hedging properties of government debt and that kind of covariance issue. So I don't know, Ricardo, if you've thought about that question.
Yes, I have. So two or three related points. The first one is when I talked about safety, I talked about safety, or better even, aggregate uncertainty that you can control. And so what I meant is, in a world in which the aggregate uncertainty is spuriously provoked by a central bank that's just creating, say, inflation risk in the economy, in that case, clearly lowering that aggregate risk would be good for welfare. You just have an aggregate risk that you didn't need to have. Again, in this very simple theoretical sense. Crucially is, what does that mean for, so that's the welfare question is trivial. The budget question is the more interesting one, and that is to show that actually that also relaxes the budget constraint of the government, because by having less inflation risk, you've increased the safety of government bonds and you've relaxed that budget constraint. Starting from that, let's make it more interesting. But what if instead volatility in inflation is good in a Ramsey taxation sense, because that is the optimal Ramsey policy, where you're going to use volatility of inflation to collect some seigniorage from inflation, from money, in order to potentially fund things, and that will actually be part of the classic Phelps second best analysis or Ramsey analysis of optimal taxation. Use the inflation tax. Well, then the novelty here is add that to what I said, and you say, now it depends. We have that, yes, you're increasing your currency revenue when you want to, but on average, you're lowering the debt revenue term. And so now it's no longer clear whether you want to tie your hands and not use the debt revenue, and not use your ability to inflate or not. Third question, and which is the one you raised, is what if I have taxation in order to pay for my debt? How do I, and that taxation is going to have to be risky or safe, following, of course, the seminal work of Robert Barrow on debt smoothing, on tax smoothing. That work says, look, smooth taxes have less risk facing the household. Let the government absorb some of that risk in terms of the government debt be the thing that fluctuates. But at least there's always going to be risk, but let's smooth out the taxes so that we don't create intertemporal predicted volatility, right? Now, as you said, and as in the Jiang paper, building on this, saying, well, but if you look empirically, the government does seem to not perfectly smooth or smooth in part, maybe, but importantly, you're always trading off more risk for the household, more risk for the government. Now, starting from here, let's bring in then my extra term. My extra term says, or that revenue term, and this is the paper by Amir Yaron and Lucas Schmidt, and also the paper by Angeletas and Collard, who are starting here, and they're saying, well, but you have this risk on taxation, but of course, there's also the risk on the size of the debt revenue term. Can you not use the debt revenue term as this extra stock of revenue to achieve a little bit of the best of both worlds? Be able to no longer introduce risk into the aggregate economy. This is very much the Angeletas Collard Dallas one. Use the debt revenue term as your buffer so that you can achieve both the smoothing of taxes and not have to pass on the risk to the future taxpayers. That's a plus. On the minus side, Amir Yaron, Lucas Schmidt, and I'm missing one of their co-authors, but anyway, Schmidt and all, or Yaron and all, I forget now. Instead, they say, no, but hold on. When you try to use the debt revenue term, note that ultimately, what you are doing is increasing aggregate risk in the economy. That's going to increase risk premium on all assets. You're increasing, if you want, the M bit, the risk of the M minus G's, and therefore you're lowering all present values, and ultimately you increase long-run risk. So again, as I've tried to emphasize, I am not giving you the answers, but I'm showing you how much excitement there is of understanding all these new effects and how they go about them. So your point, Klaus, is completely correct. The classic point on that first term in some ways, but note how it interacts with that revenue term. That is what I was trying to bring light to or present to you guys, especially since it's such a recent literature that has been writing this paper.
Thank you, Ricardo. So Leo van Tatten raises the issue, of course, when you think about the full-scale public sector balance sheet, and you think about the fact that now, with central banks holding quite a bit of debt, you also think about the role of reserves and interest-bearing reserves. do you have any kind of extension or incorporation of that dimension?
Right. So 2 points. First, on the monetary fiscal interaction in terms of the debt revenue, that's really the paper by my colleague Andres Velasco or Guillermo Calvo, which are very much going to what Leopold wrote in terms of, well, but these are two different sources of fiscal revenue. They emphasize the difference being that one, that which prices are sticky, the goods prices versus the debt prices. And they make one particular assumption, which we can argue, make a different one, but at least understand it from that angle. Your point is, what about reserves? Let's look at in between. Let's look at neither currency nor government debt, but reserves. Well, 2 points about reserves. The first one is that insofar as you think that the last 10 years and the experience with QE has shown us that different types of government debt, and in particular, public debt issued by the Treasury versus public debt issued by the central bank, in the sense of public liabilities issued by the central bank, are different, such that when you swap one for the other, we have some effect that we observe on interest rates and output and others. Then you end up with, well, the composition of the public debt will affect ultimately the different extent to which you can extract that revenue from it. This goes back then to, and all those models are linked to what I was saying. They're models of how high reserves are relative now to government debt, if you want, or different types of government debt, whether they are more liquid, more safe, more convenient, and so on. Well, this essentially leads to what? In my equation, I had one debt, but I had this one equation when I talked about QE, where I said this would instead be the sum of the premium or different types of public liabilities times the amount outstanding of each one. If one of those is reserves, another one is, I don't know, 10-year government bonds. When we've changed that composition, has that increased the size of the debt revenue term or has it reduced it? I don't know, but we can certainly use the rich literature on QE over the last few years to ask that question. Note, I would be using its estimates with a very different perspective. I'd be looking at what happens to those spreads, like all this literature on when the ECB buys another billion, what happens to this or that spread, put them into that term. Did the ECB tighten or loosen the government debt constraint when it did one of these policies? Very different perspective from the usual one, not because of the effect on present value surplus, not because of the R on the present value surplus discounting, but because it may be lowered or increased the debt revenue term. And finally, and getting to it in terms of welfare, is this a good thing or a bad thing? Again, this goes back to Klaus's general, if you want, point in question, which is, or even a point that I also made, which is increasing that revenue term is not the same as welfare, not at all. And for that, I particularly like us to not forget the Repression Premium literature that already a long time ago noted that Repression Premium are good for the government budget constraint, they're not good for welfare. With all these different microfinancial effects, it depends. So the extent to which, like I said, the swaps, the QE has increased or lowered the debt revenue term is, I think, something that I haven't seen answered, but which I think a lot of the ingredients are there that would allow us to answer it.
Let me give you two design questions. One is from Jacopo, which is basically saying, if you're going to do a debt consolidation, so choices between government spending, I guess, between strengthening consumption and investment, in relation to taxes, the restructuring option and structural reform. If you start to think about, well, maybe the choices there will influence the debt revenue term.
Yep.
Number one is that true, and in what direction, and in turn how that might influence choices. So that's what Jacopo raised. But what I had wanted to ask you is another design question. If you think about a federal fiscal system, it is some systems there's a lot of federal debt, other systems there's a lot of state level, provincial, municipal debt. And if you take a general government point of view, my kind of top of my head conjecture is it kind of depends what is driving the debt revenue term. Is it the bubble? Is it the convenience yield? We'll tell you whether there's a ranking between having a single issuer versus allowing all sorts of, because we know, lots of the bond market is not particularly liquid. Yeah. So it'd be obvious with liquidity, but maybe with some of the other stories, there's more nuance. So let me throw those questions out. But actually, knowing Ricardo that we're kind of probably the last few minutes, I just want to see. Just see before, because it essentially be last round. You can kind of pick and choose in the last round. but I think actually Klaus has a follow-up, but I think I'll leave Klaus to chase you by email on that one rather than, okay.
No, I mean, those are, in some sense, my answer to those two questions. The questions can be short in that it is basically saying, absolutely, I think you guys are right. Both you and Jacopo are right on the money in terms of, here's interesting questions to think about them. In terms of, have I seen a paper that has addressed those? No. So my answer to you is go write that paper. I think Philip is a little busy, but Jacopo, I think maybe has a little bit of time to write that paper, or maybe both papers. In terms of, absolutely, I mean, I think, what I try to reveal, hopefully, is the excitement that comes with there being a new elephant in town. There's a new term, there's trade-offs. I don't know, if you're an academic like me, you kind of get excited about, let's understand this term, measure it, its trade-offs. And you raise two more dimensions under which it's important. Following up in particular on Philip's one, absolutely. If we think about, we want to relax the budget constraint, and here we are borrowing each local, and we think that a big source of the debt revenue term, which again, crucially, the theory, what it points to directly, you always want to be asking, what makes this debt special? What drives an M minus R? And if you think there's economies of scale in the rough sense of, if you have more of it out there, it's going to be more liquid, then you say, boy, we should really be concentrating, issue only one federal debt because we'll be able to reap more of it. And maybe this is an argument for federal debt insofar as, and we can even quantify it, how much do you get relative to the existing fractured, let's say, state level or regional debt in order to, by reaping that liquidity. Likewise, if you think that, look, it is the safety of the debt, not the liquidity of the debt that matters, that's really the most important driver of M minus R. And of course, in the data, it will be a mix of all of it. If it's really the safety of the debt, you think, well, maybe federal debt is a way to create safer debt. Maybe we could create safer debt by just having one federal taxation authority, or simply a pooling of resources, or a joint and mutual liabilities, or simply some smart creation of, say, like for instance, an SB or European safe bond or something, but we can make that safer. Well, you'd collect some debt revenue from doing that, as opposed to having the currently fragmented Spanish bonds, German bonds, and Belgian bonds. Again, we could put a number to this and say, by issuing such a common debt, we would benefit in terms of revenue for the government this amount, and we can go about measuring them. But of course, I just gave, I think, two that go in the same direction. Sorry, that's just lack of my imagination. We could probably come up with arguments that go in the opposite direction. And I think that's, the best advertising for research. Let's consider these different ones, measure them, see which one is bigger. But I'm very much on board with your suggestion of saying, once you start thinking about that revenue term, what I hope I showed you is you need to start thinking about M minus R, what's special about that. Once you start measuring there, you end up thinking about regional versus federal debt. What's more special? What demand they satisfy? What role do they play? And I think if you're in that direction, you're in the right direction to answer it, even if I can't answer it here.
Very, very good, Ricardo. Let me just mention, by the way, just one slight variation on that. What's interesting, of course, one element of specialness is if you take a monetary union, of course, it is different consumption price levels in different countries. So if you're trying to think about what protects me against my own inflation risk, or in the long term, my price level effect, there are examples in the euro area of national bonds being indexed to the local price level, not just to the euro area price level, and that is relevant to some extent anyway for some of the member countries. Okay, with that, Ricardo, it's been a fascinating hour, and actually I join the others to say this is really a fantastic overview, and I think the slide deck you provided and the related work will provide a lot of food for all of us to digest. And this is really, as you say, it's a breakthrough type analysis, this family of work, which will, I'm sure, be with us for a long time to come. With that, I believe it's a time for a break so we can recharge before we listen to the next paper. So thank you again, Ricardo. Thanks from all of us. Thank you.
Thank you, everyone.